It now takes an average of 10 years from discovery to first production for a new silver mine. 10 years of permitting, environmental reviews, community consultations, legal challenges, and infrastructure development. Meanwhile, demand is growing 8 to 12% annually, and existing mines are depleting. This is not a temporary bottleneck. This is a structural supply crisis that cannot be solved at any price in the time frame that matters. If you want to understand why the silver shortage is inevitable and permanent, subscribe now and see the supply dynamics clearly. Let's establish the brutal mathematics of silver mine supply. Global silver production in 2025 was approximately 26,000 tons, or 835 million ounces. That sounds like a lot until you break down where it comes from. About 30% comes from primary silver mines, mines where silver is the main product. About 70% comes as a byproduct of copper, lead, zinc, and gold mining. This structure creates a critical problem. Silver supply is largely determined by the economics of other metals, not silver itself. If copper prices fall and copper mines slow production or shut down, silver supply drops as a consequence, even if silver prices are high and demand is strong. Miners can't just produce more silver in response to demand. The geology doesn't work that way. Now let's talk about what's happening to existing supply. Ore grades are declining across the industry. 20 years ago, a good silver mine might have ore grades of 300-400 grams per ton. Today, new discoveries are coming in at 100 to 150 grams per ton. That means you have to move 3 times as much rock to get the same amount of silver. More energy, more labor, more environmental impact, higher costs. Several major producing mines are approaching end of life. The Cannington mine in Australia, once the world's largest silver producer, has been in production decline for years. Fresnillo's mines in Mexico are maturing. Grades are falling. Production is flat to declining despite massive capital investment, and the replacement projects aren't coming online fast enough. Here's the mechanism that's choking off new silver supply. When a mining company discovers a potential silver deposit, the path to production looks like this. Years 1 to 2, exploration and drilling. Confirm the deposit exists, estimate size and grade, prove economic viability. Years 3 to 4, preliminary studies. Metallurgy, environmental baseline studies, initial permitting applications. Years 5 to 7, permitting and approvals. Environmental impact assessments, community consultations, government reviews, legal challenges from NGOs or local groups. This is where most projects die. In Mexico, permitting timelines have extended from 18 months to 3 to 4 years due to increased environmental scrutiny and community opposition. In Peru, social conflicts and protests have shut down multiple proposed mines before they even break ground. In the United States, permitting for a new mine can take 7 to 10 years if it happens at all. The Resolution Copper Project in Arizona, one of the largest undeveloped copper deposits in the world, which would produce significant silver as byproduct, has been in permitting for over 15 years and still hasn't been approved. Years 8-10, construction. If you make it through permitting, you still have to build roads, power infrastructure, processing facilities, tailing storage, housing for workers. By the time a mine goes into production, a decade has passed and $500 million to $2 billion has been spent, and that's assuming everything goes smoothly. Now layer in what's happening with labor and operating costs. Major silver-producing regions, Mexico, Peru, Bolivia, are experiencing significant labor unrest. Miners are striking for higher wages to offset inflation. In some cases, they're demanding profit sharing or nationalization. In 2024, Peru lost approximately 15 million ounces of silver production due to strikes and social conflicts. In Mexico, labor disputes at several Fresnillo mines disrupted production for months. These aren't temporary issues. These are structural shifts in the political economy of resource extraction. Communities near mines are no longer willing to tolerate environmental damage without compensation. Workers are no longer willing to accept dangerous conditions for minimal pay, and governments are increasingly responsive to local opposition, especially in democracies where mining communities can vote. Beyond labor, operating costs are skyrocketing. Energy costs have doubled or tripled in many regions. Mining is energy intensive. Crushing rock, processing ore, refining metal all require massive amounts of electricity and diesel fuel. When energy costs rise, marginal mines become unprofitable and shut down. Water is becoming scarce in key mining regions. Chile, Peru, and parts of Mexico are facing long-term droughts. Mines need massive amounts of water. Communities need water for drinking and agriculture. Conflicts over water access are intensifying. Environmental regulations are tightening globally. Tailing storage requirements are stricter after several dam failures in Brazil and Canada killed people and caused environmental disasters. Each new regulation adds cost and time to mine development. The result, it's harder, slower, and more expensive to bring new silver supply online than than at any point in modern mining history. Let's look at what happened in the uranium market in the 2000s because it's the perfect parallel to what's coming in silver. In the 1990s, uranium prices were low, around $10.15 per pound. Demand was flat. Nobody was building new nuclear plants. Mining companies stopped investing in new uranium mines. Why develop expensive projects when prices were low? Existing mines depleted. Production fell from about 60,000 tons per year in 1980 to under 40,000 tons by 2000. Then demand started growing. China announced plans to build dozens of nuclear reactors. India followed. Even the US and Europe started talking about a nuclear renaissance. Uranium prices began rising, $20, $30, $50. But supply couldn't respond. It takes 7-10 years to develop a new uranium mine. The industry had been underinvesting for a decade. Prices spiked to $137 per pound in 2007, a 10x increase in 5 years. The companies that owned uranium mines or had stockpiles made generational wealth. The utilities that needed uranium to fuel reactors got crushed by skyrocketing costs. Eventually, supply increased, new mines opened, and prices normalized. But it took a decade. Silver is following the exact same pattern, just on a different timeline. We've had a decade of underinvestment in new silver mines because prices were suppressed and capital was tight. Demand is now growing rapidly due to industrial uses: solar, AI chips, EVs, 5G. Supply can't respond because of the 10-year development cycle. And unlike uranium, where demand could be rationed, utilities could run existing reactors longer, delay new builds, silver demand is locked in by technology deployment that's already underway. You can't build a solar panel without silver. You can't manufacture an AI chip without silver. The demand is non-negotiable. Here's the irreversible dynamic that's already locked in. Even if silver prices doubled tomorrow to $60 per ounce, even if every mining company immediately started developing every known silver deposit, it would still take 7 to 10 years before meaningful new supply came online. That means the supply deficit we're facing over the next 5-7 years cannot be solved by new mine development. It can only be solved by demand destruction. Industries stop using silver, won't happen because there are no substitutes for most applications. Price rationing, silver price rises until marginal uses become uneconomical, will happen. But even this has limits because industrial users will pay high prices to secure supply. Recycling, recovering silver from old electronics, jewelry, industrial waste, helps at the margin but can't scale fast enough. Drawing down existing inventories, COMEX warehouses, ETF holdings, government stockpiles, finite and shrinking. The math is brutal. If industrial demand grows 10% per year and investment demand grows 15% per year, both conservative estimates given current trends, total silver demand in 2030 will be approximately 1.4 billion ounces. If mine supply stays flat at 835 million ounces, optimistic given depletion rates, and recycling contributes 200 million ounces, total supply is 1.035 billion ounces. That's a 365 million ounce annual deficit. Where does that silver come from? It comes from existing stockpiles, COMEX inventories, ETF holdings, above-ground investment silver, all of which are finite. At a 365 million ounce annual deficit, existing stockpiles get drained in 3 to 5 years. And then what? Then price rises until demand is destroyed or substitutes are found. But for most industrial applications, there are no substitutes, so price just rises until somebody can't afford it anymore. So what does this mean for you as an individual investor? If you own physical silver right now, you own a piece of infrastructure that the global economy needs and cannot easily replace or expand. You are holding a strategic commodity in a structural supply deficit that worsens every year and cannot be solved by market mechanisms in the relevant time frame. That's not speculation. That's mathematical reality. If you don't own silver yet, you're underweight an asset whose price is almost certainly going significantly higher purely based on supply-demand fundamentals. Not because of inflation, not because of monetary policy, not because of speculation, because there physically is not enough of it to meet demand at current prices. Let me make this concrete. Right now, solar panel manufacturers are building factories to produce panels that will be installed in 2027, 2030. Those factories are being built based on the assumption that silver will be available at $30-35 per ounce. But if our supply-demand math is right, silver won't be available at $30-35 in 2028. It will be $60, $80, maybe $100. What happens then? Solar companies will pay it. They have no choice. The factories are already built. The panels need silver. They'll pass the cost to consumers or eat it in margins. AI chip manufacturers are in the same position. They're designing chips and building fabs based on silver availability assumptions that won't hold. When they realize the supply isn't there, they'll bid aggressively for whatever is available. And the retail investors who stacked silver at 25-30, the Wall Street silver community we covered in video 8, they'll be sitting on 3x, 4x, 5x returns. Not because they got lucky, because they understood the supply-demand math before the industrial users panicked. Let's talk about what mining companies and resource investors are doing. Junior mining companies focused on silver development are attracting capital again after a decade of being ignored. Funds like Sprott are investing in silver development projects that have permits or are close to permitting approval. Why? Because they know that the handful of new mines that do make it through the permitting gauntlet will be extraordinarily valuable when supply is tight. Major mining companies, BHP, Rio Tinto, Glencore, are looking at their copper and zinc projects with new attention to the silver byproduct credits. A copper mine that produces 10 million ounces of silver per year as byproduct used to view that as a nice bonus. Now they're viewing it as a strategic hedge against copper price volatility. Even sovereign wealth funds are looking at direct investments in mining assets, which is unusual. Typically, they invest in mining companies through equity. Now, some are considering direct ownership of mines or offtake agreements, guaranteeing to buy all production at fixed prices. This is what happens when sophisticated capital recognizes that a commodity is moving from abundance to scarcity. They want direct exposure to the physical supply, not just paper claims. Here's the absolute clarity moment about what mining supply constraints mean. We live in a world where technology is advancing faster than resource extraction can keep up. We're deploying solar panels, AI infrastructure, EVs, 5G networks at exponential rates. All of it requires silver. But we're simultaneously making it harder to mine silver through regulations, permitting delays, environmental restrictions, and community opposition. Many of these restrictions are justified. Mining has caused real environmental damage, and communities have legitimate grievances. But the consequence is that we're creating a world where demand for silver is accelerating while supply is structurally constrained. That ends in one place: much higher prices, not next month, not next quarter, but over the next 3 to 7 years as the deficit becomes undeniable. And the investors who position before that becomes obvious are the ones who capture the repricing. Think about what happened with lithium. In 2020, lithium was $6,000 per ton. EV adoption was growing, but supply seemed adequate. By 2022, lithium hit $80,000 per ton because nobody had invested in new supply for a decade and suddenly every automaker needed it. A 13x increase in 2 years. The people who bought lithium miners or physical lithium exposure in 2019-2020 made generational wealth. The people who waited until 2022, when it was obvious, paid the high price. Silver is lithium 2.0, just bigger and more critical to more industries. Here's your move. Step 1, accept that the supply deficit is real and cannot be solved quickly. This is not a temporary disruption. This is a structural imbalance that will take 5 to 10 years to resolve even under optimal conditions. Step 2, build a position in physical silver before industrial panic buying begins. Coins, bars, allocated storage, whatever form gives you actual exposure to the metal, not paper promises. Target 10-15% of your investable assets if you're conservative, 20-25% if you're convinced by the thesis. Step 3, consider mining company exposure for leverage. Primary silver miners will see profit margins explode when silver prices rise. A company mining silver at 18 Oz all-in costs will see profits double if silver goes to $45, even though the price only went up 60%. That operational leverage translates to stock prices that can go up 3x, 5x when the metal doubles, but only invest in quality companies with permitted projects, good management, and strong balance sheets. Step 4, ignore short-term volatility. Silver is volatile. It will swing 10-15% in a month sometimes. The fundamentals don't change when the price swings. The deficit is still there. The 10-year development cycle is still there. Hold through volatility. Step 5, be patient. This thesis plays out over years, not months. But when it plays out, the move will be violent and those positioned early will be the ones who benefit. 10 years. That's how long it takes to open a new silver mine from discovery to first production. 10 years of permitting, environmental reviews, community consultations, infrastructure development. Meanwhile, demand is growing 10% per year. Meanwhile, existing mines are depleting. Meanwhile, industrial users are building factories based on the assumption that silver will be available when they need it. It won't be. Not at $30 per ounce. Not at current supply levels. The deficit is locked in. The math is unavoidable. Somebody is going to pay $60, $80, $100 per ounce to secure the silver they need. The only question is whether you'll own the silver before they start bidding, or whether you'll be competing with solar companies, AI chip manufacturers, and EV producers for a shrinking pool of available metal. The supply crisis isn't coming. It's already here. The mines that could solve it are still 7 to 10 years away from production. And the people who understand that timeline are buying physical silver right now. While it's still available, while the price still reflects abundance rather than scarcity, the window is closing. Position accordingly.